Hey everyone, Joe Stanovic here, Certified Financial Planner. And first off, please excuse me, I am just getting over a nasty cold or the flu maybe, is according to the doctor. Got a flu shot, but still knocked me out, so I'm a little congested, but here we go. Today's video is still on theme of capital gain. So I did a video a couple weeks ago talking about mutual funds and capital gain distributions. And I wanted to somewhat piggyback off of that because we are going into the end of the year. And this video is specifically about tax loss harvesting throughout the year versus waiting until the end of the year. So first off, tax loss harvesting, like what in the world does that even mean? Our industry is just full of so much jargon, and that is a perfect example of jargon. In essence, what tax loss harvesting is, it's selling an investment that is underwater, that's down in market value from your initial investment value. And when you do that, there are some tax advantages because it will offset other taxable income that you have. So this year in particular, obviously we know the market has been rocky for the market. At one point, the stock market was down about 25% off the highs. It's recovered some and we're down maybe around 15% for the year. So let's just go with a specific example so that you understand what I mean by waiting until the end of the year versus being proactive throughout the year with the strategy. So let's say on January 2nd, you invested $10,000 into the stock market, okay? And by June, the middle of June, that $10,000 was worth about $7,500, or you had lost or drop in portfolio value of $2,500. And then, so it went from down about $2,500 to now you're down maybe about $1,500. So you have had some recovery, okay? But in June, what you did is you sold those investments and you realized a loss. And then you bought something else. You did something else with the money, but you stayed invested in the markets so that you were able to experience some of the rebound, okay? So by doing that in June, you were able to capture a $2,500 loss for a capital loss for tax purposes. If you had not done that and you looked to do it now, you would only have an unrealized loss of $1,500. So therefore, if you did the loss harvest strategy now, you would only be able to offset $1,500 of other income versus $2,500 had you been proactive about it. So the point of this is that tax loss harvesting or proactive investment tax planning, think of another word besides tax loss harvesting. But the point is that you shouldn't just be looking at harvesting losses or harvesting gains in December. It is a year-round event. It is not a requirement to do it in December. You can do it in June, July, January, November, it doesn't matter. There are limitations, but for the purposes of this conversation, it is not just a December strategy. So I hope that you have been looking at it throughout the year, and you haven't, that's okay. 2023 is a new year. If you have any questions, feel free to reach out. Have a great day.